This is Theta explained, what it is and how to trade it.
Hey guys, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about theta. So over the last few days, we've talked about delta, we've talked about gamma, and how they're related to each other. So just a quick recap, delta is the rate of change of an options price, and gamma is the rate of change of delta. So those are two tied together pretty tightly there. But
Hey, you know what? Before we get too deep, if you've heard me talk about delta, if you've heard me talk about gamma, put it in the chat. Type delta, type gamma in the chat. I'm just very curious how many of you have heard me talk about these things, because these concepts are super important. If you want to be a successful options trader, you need to understand what all of these components of options pricing are.
But theta is a little bit different. So when we're talking about theta, we're talking about the rate of decay of an options price, all else equal. So what we're going to do today is kind of basically look at two different scenarios. So we're going to look at a 45 DTE option, or days till expiration option, and we're going to compare that to a 5 day till expiration option and just see what the differences of those are, and also how theta is affected from a buyer's perspective in terms of option prices and a seller's perspective in terms of.
Now, I know, while I pull up my PowerPoint here, I know that he is going to rag on options buyers. Just be ready for that off the top. Be ready for that as he goes through. But I will counter every point that he has with anecdotes of my personal trading experience, as well as much data as I can possibly manage.
So option prices. So let's get into it and look at theta on basically a bell curve level, or what you'll see here is more of a linear slope, if you will. So when we're looking at 45 days till expiration, one thing to note is that obviously the most value in extrinsic value is going to be at the money.
Okay, let's talk about this real quick. Let's talk about intrinsic and extrinsic. Intrinsic is the calculation of the current price of the stock minus your strike price. So I didn't pick this one for any particular reason. It was just whatever I had looked at last time. In you, $14.86 minus the $14 strike price. So 14.86 minus 14 gives you 86 cents in intrinsic value. We know that for sure, hands down, no matter what. This will always be the same. Intrinsic value is the current price minus your strike. Now, extrinsic value takes the difference. So let's imagine midpoint here, takes the difference here in the price, the midpoint of price, to intrinsic value here. So for example, if we're doing 105 minus 86, 1.05 minus 0.86, that gives you 19 cents of extrinsic value. Hitting the midpoint there gives you 17 cents. Okay. Extrinsic value incorporates all of the other aspects of the options pricing. So delta falls right into your intrinsic, because this is the rate of change for every $1 move in the price of the underlying stock. Extrinsic is everything else. This is your time decay. This is your volatility. This is your row. You know, name every other Greek that goes into the options pricing. It all falls into extrinsic value. So one thing to keep in mind is that extrinsic value is most expensive at the money. I don't know if he's going to describe that exactly, but that's what this is saying here: is at the money, out of the money, out of the money. At the money is the most expensive options. Now, we've talked about before how to judge an option if it's expensive or if it's cheap. Let's go to an option that has more strikes. Let's go to like Palantir. By the way, I know my shit. I know this inside out, backwards, upside down, both hands tied behind my back, blindfolded. I know my shit when it comes to trading options. So if we look at this, extrinsic value peaks. See, the price goes up and up and up and up and up, peaks right at the money, and goes down and down and down and down and down. That's what this is describing right here, where the extrinsic value peaks right there. Now, like I say, remember, extrinsic value encompasses not just theta. That is only one portion of the extrinsic value. And when I say a cheap option versus an expensive option, let's look at this. Every single penny of this 160 strike, the 565, so that's mid price between 560 and 570, every single penny of this is extrinsic value, which will decay over time, period, to the end of time. Any option on any contract, on any expiration, on any stock, always extrinsic value will decay over time, period, hands down, full stop. Okay. Extrinsic value will always go down. Intrinsic value is the calculation between the price of the stock and the price of the strike. Okay. We know that for sure. We don't have to cover that again. Now, the deeper into the money you go, the less you have to pay. We already talked about that, but also the percentage of what the extrinsic value is to the ask price is. So let's go to around the 80 delta. That's Chris's favorite. So if we go $2.03, 2.03 divided by the price of the option, 19.25, that means only 10% of this. Now, I know for sure that we will be covering this in a little bit, which is why I'm trying to head it off ahead of time. Okay. Trying to head this off just because I know he's going there in a minute. Only 10% of this option is extrinsic value, whereas 100% of this option is extrinsic value, right? There is no intrinsic. It is all extrinsic. So to me, this is a inexpensive option. This is a very expensive option, even though this one, let me see if I can highlight it better. Here we go. Costs significantly more, basically 4 times more for this one versus this one because of the theta decay, the amount that will decay over time. This one actually is significantly more expensive than this one. How would you come up with that idea? This has 16 days to expiration. I just picked that point at random. 565 divided by 16 days. All right, hang on. Divide by 16. No, damn it. Hang on. 5.65 divided by 16 equals 35%. That can't be right. Yeah, 35. No, 3.5%. 3.5% of this times 100. I messed up somewhere. Anyway, it's 3.5%. So 5.65 divided by 16 days. 3.5% of this will decay every day until all 16 days have passed. Like, let's just do 3.5 times 16. Hang on a second. Hang on just a cotton pick a minute here. Maybe I'm doing something wrong. Where's my math here? $5.65, 5.65 divided by 16 days. Oh, maybe I'm doing it backwards. 16 divided by 5.35. There we go. Sorry, my bad. 2.99% of this. Okay, my bad. So 3% will decay per day, every day, until the 565 is gone. So 3% per day, every day. Whereas if we go to this one here, 2.91, 16 divided by 2.91 equals 5%. Frick, I've totally messed up my math here. What am I doing wrong? 35 cents a day? Oh, 35 cents a day. Okay. 5.65 divided by 16 is 35 cents a day. Okay, I can live with that. My bad. And then 2.03 divided by 16 is 12 cents a day. Okay, thank you very much. I apologize for the math. So 35 cents a day will decay versus 12 cents a day. And you divide 35 divided by 12 means it's 2.91 times as fast. The decay, I know I need Scott. I need Scott so bad. 2.9 times more expensive. So it's 3 times more expensive per day that this is going to decay. 3 times more expensive per day that this is going to decay. All right. So with all that out of the way, and I apologize for the arithmetic there, but thank you for your help. Let's get this done.
So theta is basically the rate of decay of an option's price. So if we're looking at extrinsic value specifically, we've got the most extrinsic value in the at-the-money options because, again, extrinsic value is made up of volatility and time. So the most volatility is going to be right at the money because that's the closest in terms of becoming valuable and not being valuable.
Exactly. And this is where I like to call the extrinsic value the uncertainty value. The uncertainty value, because we are assigning how much uncertainty there is between now and expiration if it will or will not be in the money.
And also, when you're looking further out of the money, there's going to be less extrinsic value and less probability of being in the money or out of the money. So there's going to be that slope as you see here. Now, when we compare this to a 5-day till expiration value, you're going to see that it's a little bit different. So if we're just conceptually visualizing this as just a total dollar.
Now, the reason that this is lower at 5 days to expiration versus 45 days to expiration is that there's less uncertainty, right? Remember, I just told you that extrinsic value should be considered your uncertainty value. Now, let's look at a couple examples here real quick, right? Let's go to the 130 strike here at 16 days. Has $1.11 extrinsic. Let's go to the 130 strike here at 2 days, has 13 cents of extrinsic. So between these 2 points is 14 days. Yeah, it's 90% less, give or take, Check my math on that one. 90% less, give or take, extrinsic value to go from the 130 strike that expires in 16 days versus the 130 strike that expires in 2 days. And that's because there's significantly less uncertainty between the two time periods.
Value, you'll see that, of course, the 45-day till expiration curve is going to be higher and have more value because there's more days till expiration. So there's going to be more premium in that. So if I'm looking at an option to sell,
as he talks about premiums, imagine that's the extrinsic value. And he just talked about, and he's going to talk about, do not listen to selling options.
there's going to be more premium. It's going to cost me more, or I'm going to receive more as a credit if I'm looking to sell a 45-day till expiration option compared to a 5-day till expiration option. But
so this is why, as he's talking about selling options, I may not make it through this video because I don't want you to ever consider this to be a sound, viable strategy. When I'm going to buy an option, I want to spend as little extrinsic value as I can. My absolute max, I will not spend any more than that, is 30% of the total options price. But if I can do 20%, that's usually the ballpark that I'm at 80 delta, and even less, I'm good. I'm good. So again, anytime he talks about selling options, just let it go through one ear and out the other. We can learn about theta without that.
But what I wanted to display here is simply that the at-the-money options are going to have the highest theta value because that's where the most extrinsic value is, regardless of the expiration cycle. So let's get into what it looks like for buyers and sellers. So if we go to the next slide here, we'll take a look at what an option is. So we're looking at buyers and sellers. So when we're talking about theta,
first off, that just irritates the shit out of me. Sellers are green and buyers are red. That's weird because like literally every time in the history of time, isn't it like when you buy an option that it goes green? I forget. Either way.
specifically, it's good for sellers and it's bad for buyers. So let's think about this as a bucket of water. So if I've got an option that I bought and the value is a bucket of water and the extrinsic value is made up in time of volatility. So if I buy an option contract and I'm basically saying over the next 30 days, I think the stock price is going to go up. So let's say I buy a call and
agreed. I'm on board with this. What he's going to tell you is that theta is going to decay. Theta is going to decay over time, therefore ruining the value of that option. And it would if you were buying out of the money options. Because as we discussed earlier, out of the money options are completely full of extrinsic value, and it will decay at a faster rate than one that is deep in the money. So if you find one that's, in this example, I previously had 13.9%. 13.9% of this will decay over time as a leveraged investment. That's the deep in the money 80 delta calls. 100% of the extrinsic value, remember the uncertainty value, 100% of that will decay to zero if you are out of the money, buying out of the money calls, buying lotto tickets. And that's what he's going to tell you here, right? Is that all of these options that you buy are these terrible, shitty investments that are going to go down day after day after day. Whereas we understand the difference in buying an out of the money call versus an in the money call. And an in the money call has significant leverage without significant risk on theta decay. But please tell us how dumb we are for buying the in the money options.
I think the stock price is going to go up. So I buy a call and I'm paying premium for that right to own that theoretical 100 shares of stock for that specific amount of time. So that value or that extrinsic value is going to be this water here. So if it's bad for a buyer because we have theta decay, which is the rate of decay of the option price, all else equal. And when I say all else equal, I mean that the price of the stock does not change and implied.
Boom. Skinny buff guy, he literally just said that. All else being equal, if the price of the stock doesn't change, well, why are you buying the calls anyway? or if it's in a downtrend, why are you buying the calls if the stock of the price or the price of the stock is going down? Right? You want to be buying stock, you want to be buying hang on, I don't want to. No, stop. That's kind of cool though. But no. You want to be buying stocks, you want to be buying options as the price is crashing up, not as the stock or the price of the option is crashing down. Okay? Buy stocks as they're crashing up, not as they're crashing down. So with that out of the way, you don't want to be buying stock that's going sideways. If you buy a stock and it does nothing That sucks. Same as if you bought an option and it does nothing, that sucks. That's why you want to have all of your analysis, all of your outlier data, everything working in your favor to tell you the trend is moving up and you don't have any overhead blockages in the way like AMD has right here. Okay. That's what we're looking for. That's where you need to be thinking. Don't think about a stock just sitting sideways. That's dumb.
Volatility does not change at all. So if you just freeze the entire operation, if a date of time passes, then whatever your theta value is, that's what the option price should decay by. So
Okay. And he's 100% right. Every day that passes, you are having the decay happening. It is just a fact. It's an unavoidable fact. But you can either look at it from one of two directions. You can say, oh no, I can't trade options because I have this thing working against me every day. Or you can look at it as a business owner and you can say, I understand that there will be costs associated with the goods that I'm going to buy. This is like your cost of inventory. Okay. There is a cost associated with anything as a business owner. This is my overhead expense, whatever the case is. Now that I'm aware of that, I need to make sure that I plan around that. I need to make sure that I include that as part of my trading plan. And therefore, it's not unexpected and it's not going to be that big a deal.
So if I'm buying an option,
Oh, to that point, this is his brother. So Chris Butler is the one that we talked about in options OVTLYR University. This is Mike Butler. This literally actually is his actual brother, and I've had a chance to speak with both of them.
and I know that the option price is going to decay or decrease, that's going to be bad for me because of the fact that when I buy something, I need to sell it to get out of it. But the reverse is true for selling options. So when I drop this flap here and we start selling options, you're going to see that it's basically a two-way street. So since a contract is a two-way transaction, if there's a buyer and a seller on the contract, if theta is bad for the buyer, then it's got to be good for the seller.
Okay. So here is where the selling looks sexy AF. The selling options from exactly what he's talking about looks like it is the most sexy, beautiful thing of all time. And yeah, they have it listed as green because theta decay works in the favor of the option sellers. They think that this is the most beautiful, smart, perfect thing ever if you are an option seller. But I'm telling you right now, it is bogus. It is a succubus. It is the most insidious way of trading of all time ever. Why? Why? Now, let's say that you sold this option, okay? And you're going to get paid every day, okay? Imagine this is how much you're getting paid from 0 to 100. You're going to get paid every day. Sure, that sounds great. The issue is that you must. There's no other possible thing you can do other than hold on to this option day after day after day after day, waiting for that time decay to come into your account. So you must hold it and 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 hold it. And you have to go all the way to expiration to get the entirety of that premium that you sold. The issues here is, let's say that you were selling options and you were selling put options, for example, and you were expecting the price of the stock to go up. And every day that goes by, you are collecting that theta. But unfortunately, you have the delta working against you. And I am so adamant about this. Do you feel strongly about this? More than anything. More than anything. And you have a capped reward with uncapped risk here. Perfect example. Let's say that you sold a put option in AMD because you were bullish AMD. And you're like, oh, AMD has to go up, right? It must go up. There's no possible way it can go down. So let's say you went, we'll just pick one at random. Let's go with like this one here. Look at all the volume here, right? Let's say you sold the 135, okay? And let's say that AMD starts crashing down to 135. The most you could possibly make in this is 63 cents. Oh, good gravy. I can't believe that I'm going to make 63 cents. The broker is going to have you put up at least 20% of what this is. So 162 times 100, 16,200 times 0.2. Your broker is going to make you put up at least 32.40. If you take 63 divided by 32.40, that gives you a paltry, amazing, a huge 1.9% return. 1.9% return on this incredible, tremendous, beautiful options trade. Good, my goodness gravy. Okay. You're not going to get paid all of that incredible 1.9% return until the day of expiration. You're going to get a little bit each day, a itty bitty, tiny bitty baby bit each day until expiration, and then you will finally get all of it. Yeah, sign me up twice. Let's go. If you can't tell, I am incredibly passionate about this because I lived this life for years thinking I was a genius because, hey, time's going to pass anyway. No matter what, time's going to pass. And therefore, that theta is just going to drip right into my account. And 84% of the time I won. But the other 16% of the time I lost my ass. As it goes down and down and down and down and down, I can't do anything about it. I can't close the trade because what if it comes back? What if I have why would I close it now when it has 33 days of theta decay coming towards me? Why would I do that? That's so dumb. I'm telling you, I'm so passionate about this because I lived it and I don't want you to live it. You can mitigate this. You can work against this by just going deeper and deeper into the money. Because look how much extrinsic value there is. 90 cents on this one. 90 cents on $33.20. How much is that? 90 divided by 33.20. 2.7%. So you're telling me that I either need to hold it for 23 days to make 2%. Or I can understand that as a business owner, I'm taking a business risk and I'd have a business expense associated with that business risk of only 2%. Therefore, 98% of this options price is working for me. 98% of this options price is going to move in my direction with the delta and help me so much. Chris is wound up. Oh my good gravy. But this is why I don't want you to fall in this trap. It sounds sexy, but you're not getting paid this flood of money. You're getting paid drip by drip by drip by drip. And only if the stock moves in your direction are you getting paid drip by drip by drip. Wouldn't you rather get paid in floods as the stock moves in your direction? As you've already done your analysis, you can see the trend template. You can see everything that you want. Only take 2% of the business expense and make possibly 200% of your options? You tell me. Would you rather get paid by drips or floods? In the chat. I would rather be paid by floods. And it definitely doesn't look like this if you're selling options.
So this is one way to visualize it. So over time, as time passes, the option that I bought, if I'm buying a call, it's going to decay. So let's say nothing.
But it's only going to decay a tiny bit, an itty bitty baby bit, if you're buying the deep in the money options. If you're buying the out of the money options, yeah, of course, it's going to decay because it's a lottery ticket. Don't do that. Random guy wants to be paid in biblical floods. Random guy is Noah. He wants to be surfing the floods all day with Corey and Surfing Bird.
Nothing happened.
I will not calm down. You can't make me. This is my show.
And I bought an out of the money call. So I was gambling. I wanted to just try out a lottery ticket and see.
Okay. And that I can agree with. The out of the money calls are lotto tickets. Totally agree. But to these people at Tasty Trade who want to teach you that selling options is the only thing to do, I don't understand why they can't conceptualize how deep in the money options act completely different than an out of the money option. Now, where did I learn these option strikes? I learned this from a billion-dollar hedge fund manager. Guess how he got to billions of dollars? You think it was selling options? Rick, no, it was not selling options. He was taking leveraged investments, which is what a deep in the money option is.
if I was right. So I bought an out of the money call. If nothing happened, or if that stock price did not go high enough for that call to have intrinsic value, then basically what's going
And I'm so glad he mentioned intrinsic value. While we talked about it earlier, he's right. If this does not capture any intrinsic value, it's worthless. So why even try when you can start with 70, 80, 90% of intrinsic value? Yes, if you want to look it up, this is called the stock replacement theory. Exactly. When you already start with the intrinsic value, you don't have to wait and hope and pray that you get some. It just makes life so much easier. Oh, skinny buff guy. He learned it from me.
to happen over time is the option price is going to decay. So if that's bad for me as the buyer, then that must mean it's great for the seller. And that makes perfect sense when you think about it. So if I'm buying the call, that means someone else had sold the call to me. So if they sold it for, let's say, $1, and over time that option has decayed to 50 cents or 40 cents because Theta has been working for them instead of against me, then that's great for them, because now they sold it at $1. They can buy it back for 40 cents, which the difference is going to be their profit of 60 cents. So that's why we always say that Theta decay is good for option sellers.
And this is the insidious nature of selling options. This is the succubus nature of selling options, because it sounds great on paper. Because time will pass. As long as you're on this earth, you get to experience time passing. And listen, I'm super grateful that you've got to pass some time with me. That means a lot to me that I can be part of your day. However, this does not take into account any sort of price movement, which will happen up or down. And if you are the option buyer, you can have leveraged investments to the hilt that are going to pay you hundreds, potentially hundreds and hundreds of percents. Or if you are an option seller, you have to sit and wait and wait and wait and wait. Whereas the option buyer could be in and out and on his way.
And bad for option buyers. And that's basically the case for any type of trade. Even if I'm buying a debit spread, Theta is still going to be working against me. So that's why we like to stick to premium selling opportunities. So when we have implied volatility spikes, which we know is a result of option prices inflating, then once that happens, I have a large amount of premium that I can sell, and Theta decay is going to be high relative to what it might have been if the option price was lower.
So he's talking about the idea of the option extrinsic value inflating in value when there is higher degrees of uncertainty, and that is when the implied volatility is going up. The implied volatility means that we don't know, there's greater uncertainty associated with how much movement there will be in the stock. Now, this generally happens when the stock price plummets. Implied volatility spikes, because now we have a lot more variables. Like, hey, wait a minute, the price just plummeted. What's going on? Why is this happening so much? This will spike extrinsic value, because extrinsic value has theta decay. It has your time decay, and it has your vega, your implied volatility associated into this. Okay, so when this does inflate, that is in their terms, better time to sell an option, because hey, it's more expensive. The extrinsic value is juiced up, so therefore we can sell juicier. You can sell juicier options. You can sell juicier options as the price comes down over time on the extrinsic value. You'll be doing great. My counter to that is just move up the options chain. Because if you understand that your limit of the percent of extrinsic value to the ask price is whatever, if it's 30%, 20%, 10%, all you have to do is just go further up the options chain. Because remember, extrinsic value peaks at the money. It peaks at the money. You can see it right here on this one exactly. So my counter to that is just go further up the options chain. Not that hard. You're cracking me up, Mikey Mike. Juicier options.
in that certain amount of days. So hopefully this helps, but now let's take a look at what it means when we're looking at a 45 DTE graph compared to a 5 DTE graph. And we're going to talk about some implications of theta when we get closer to expiration. So if we go to the next slide here, we're going to take a look at the 45-day till expiration graph, and we're going to just take this look as a dollar value. So again, like we were showing before, the value for at the money options is going to be highest, and it's going to trail off in terms of extrinsic value as you go far out of the money and far in the money. Now when we compare that to a 5-day till expiration graph, you'll see, like when we were talking about with delta and gamma, when I was showing you that the curve goes from very wide to very narrow as you get closer to expiration, you can see that clearly here. So when we have 5 days till expiration, the most value is still going to be at the money, but you can see that since we've already trailed off on the outskirts, basically theta decay is going to slow, and when we're at the money, theta decay is going to increase. So let's break this down visually here, and you can clearly see this. So when we've got theta and we're looking at the money, when time passes, essentially theta is going to increase. So basically, one way to think about this.
Right. And that's what this chart is showing. Is that the closer you get to expiration, the faster the theta will decay. However, if you have a deep in the money option, it's pretty linear the entire way. So if you have an out of the money option, it may not have that much theta decay until you close in on expiration, and then it's going to fall off a cliff. But if you do the leverage investment route, like I talk about, it's pretty linear.
Is when you're very far out in time, like if you're 100 days out in time, theta is going to appear to be pretty linear. But when you get closer to expiration, theta basically spikes up for at the money options, because at the money options are still going to hold their value, but now there's only 5 days left. So if I have $1, but it needs to decay over the next 5 days, I'm going to have a pretty high theta value compared to an option that maybe I sold 50 days out in advance, and now it's got a much lower theta decay because now it has 50 days to decay as opposed to 5. So that's where that relationship comes into play. So when we're looking at the money options specifically, you're going to see theta creep up and become much more nonlinear the closer we get to expiration. Now, the opposite is true for out of the money and in the money options, and that's simply because of the fact that extrinsic value doesn't really exist anymore. So when we're looking at the 45-day till expiration graph, you can see at this first strike here, we still have a lot of value. But if we look at the exact same strike here, there's not much value left. So if I've got maybe 10 cents of value in that option over the next 5 days, of course, it's going to decay still, but there's not really much left for it to decay by. So the more it decays, the slower it's going to decay, and you should see that number go down as you see here. So those are some real key concepts with theta. One of the biggest things to note is that it's a non-linear value. So you're going to see theta jump all over the place, especially when you're looking on the platform, because this is an example when we're holding all else equal. So when we're looking at the option price and stock price not moving at all and implied volatility not moving at all, this is maybe what you might see. But since we all know that the stock price moves all over the place and so does implied volatility, we're going to see a very nonlinear and very dynamic theta value pretty much all the time. So let's get to some takeaways here. So our first takeaway is that theta is the daily decay of an option.
All right. Daily decay of an options price. As we talked about, yes, completely agree. It is a real thing, but that is the price to pay as an options trader. It is the price they have to pay to have this sort of leverage that you won't get otherwise. Okay? You're not going to get the sort of leverage you can get with options unless you understand that this is the cost associated with that happening. Theta decay is good for the option seller, for sure. But remember, it comes as drips to them. Itty bitty baby drips every single day. Does it come to them? For sure. It does come to them. But remember, it comes to them in a non-linear fashion, meaning it will be slow at first and then accelerate as you get closer to expiration. Or if you're deep in the money, it is pretty linear. It is pretty linear. This is how much the option price is going to decay. Now remember, we don't really care about the extrinsic value. we're trying to maximize the intrinsic value. And the intrinsic value is calculated by, this is the third time I've talked about it, the price of the option minus your strike price. So the deeper it goes into the money, that's what you want. Okay. This should much more than overtake. And I'm telling you, by a factor of 100 to 1, 50 to 1, 25 to 1, should overwhelm how much theta decay that you're seeing on a day-to-day basis. That's where it really matters. Your intrinsic value, the amount that the price of the option grows due to the change in the price of the stock, should overwhelm significantly, tremendously, how much you're losing on a daily basis in theta decay. All right. That's what we're trying to get after. Right? That's how we are trying to use this as a leveraged investment. And theta changes as extrinsic value and time changes. So theta and extrinsic value, remember, extrinsic value is a combination, not just theta, but it's also your time value and your implied volatility value. Okay, so your implied volatility can go up while your theta is going down, and the price of the option will remain unchanged in that case.
Price, all else equal. So again, you're going to see this pretty much jump around all the time, but if you were to freeze implied volatility and freeze the stock price, whatever value you see for theta, if you just let one day pass, theoretically that option price should decay by that amount. And regarding whether you bought or sold that option, that's either bad or good for you. And theta decay is good for option sellers, bad for buyers. So again, if I'm buying an option and I know that I'm paying a premium for that contract right to hold that theoretical shares, whether it's long or short shares over a certain amount of time, I'm basically paying for that, and I know that theta is going to be shown as a negative number for me. On the flip side, if I'm selling the option, theta is going to be a positive number for me because I know that that's a good thing for me. So if I sell an option at $1 and it decays by 3 cents every day, and that theta number is going to be dynamic, of course. But if I freeze something, if I freeze that stock,
and we're going to leave at this point right here, and where I'm going with that is he's talking about earning 3 cents a day. Okay, he's talking about selling the out of the money options, which are already cheap to begin with because they are lotto tickets, and you're only going to make a very small portion of that day after day as time passes by. And when that happens, it can be absolutely overwhelmed, which is what we are trying to do as outliers, as option buyers. We are trying to overwhelm the amount of theta decay with the amount of delta growth. This is options deep dive. We get really technical here today. So that's where I want you to remember is we are trying to get a significant move by trading with the trend of the stock. Okay, if it's trending up, if it's trending down, that's where we're at. We're not looking for a stock to go nowhere. We're not looking for a stock to go sideways. We're looking for growth of the stock. And if it's growing, then our theta decay should be overwhelming. I'm sorry, not our delta growth, our delta improvement, our intrinsic value growth should be overwhelming the amount of theta decay or extrinsic value loss to see on a daily basis. And remember, we are trying to pay as little as we can for that because we know that it should be considered a business expense. Question from Richard. For people who hold stocks as investments, does this make sense for them to try and pick up a buck or two? I mean, it's up to you, right? If you are if you're holding a stock for the long term, having no intention of selling, have nothing else to do, then selling cover calls makes sense. But if you are trading with the trend, if you're using the data to know when to get into a stock and out of a stock, then it doesn't make a lot of sense. It doesn't make a lot of sense. This is the pennies in front of a steamroller thing. Exactly. Making 3 cents a day in the face of a downtrend moving against you. And let's get really nerdy for a moment, where your extrinsic value is decaying minute by minute, day by day, but your intrinsic value is working against you tremendously. We want to be the opposite side. We want to be the people driving the steamroller. We are the people driving the steamroller. We are going to roll over all those option sellers all day, every day, because our change in intrinsic value will overwhelm anything that is happening on the extrinsic value. And clearly, you are not going to get wealthy doing this. Absolutely not, for sure. So listen, I hope that this was useful. If it was, I want to help you save time, make money, and start winning with less risk. But you can only do that by clicking one of these two videos. We'll talk soon.